So let's talk about some additional option strategies. One can be categorized into something called spreads, and another can be categorized into something called combinations. And the main idea behind both of these option strategies is that you've got more than one option working together. So you're trading multiple options at the same time, but on typically one underlying ticker. A spread typically involves buying a put and selling a call on that ticker at the same time. Of course, one might be a different strike price or a different date of expiration, and we'll see how that works in just a minute. Let's take a look at a couple spread examples. One is something called a bull spread. And again, this is for options. You do have bull spreads on futures contracts or futures options. But the main idea behind it, why it's called a bull spread, is that you expect the stock to go higher. And this is kind of your bent, your direction when you're trading this set of options. And the way a bull spread works is that you buy a call option, just like you would if you were normally bullish on a stock and you wanted to trade speculatively. But you buy a call option at a lower strike price. Let's say it's a $15 strike expiring in September. But at the same time that you do this, number two, you sell a call option on that same underlying and at the same expiration date, September. It's just that you sell the call option at a higher strike price. So I'm buying a call at 15, I'm selling a call at 20, it's the same underlying. And the way it makes you money is that you think it'll go up. So you think it'll go above 15, so that if this is a call that you're buying, the spot minus the strike, the underlying minus the strike are zero, you get the maximum of it. So if the underlying goes above the strike here of 15, then you'll make money. But the unique thing that makes this a bull spread is this selling the call option. And if you sell at the higher strike call, what you're doing is that you're expecting it, for example, to go above 15, but not go above 20. So you think it will go somewhere within this range. And why would you do that? The main reason is that, when you're selling the higher strike call, this $20 strike here, you can offset some of your cost of the original purchase of the call at the $15 strike. Recall, if you will, that with a call option, if you're buying it, you have to pay a premium. And then if you're selling a call option, you're going to receive a premium. And so by selling this higher strike call, you're receiving a premium. And then you're turning around and using that money to buy this lower strike price call, or at least to help defray the cost of it. And it's fine, it's just cheaper. If you really don't think that it's going to go above $20, then that's just a sort of a way to lower your cost of buying this call. And the payoff profile looks like this. You have a maximum loss, which is reduced, by the way, since you received that premium from selling the call and used it to offset the premium of buying this call. So the most you can still lose is the net cost of the two premiums together. If the underlying price goes below that, then your call option that you bought is worthless, but the call option that you sold expires worthless, meaning you get to keep that premium. And so if the strike price rises above, or if the underlying rises above the $15 strike, you continue to make money like a normal call option. But if the underlying moves above that second strike where you've sold that call, then this caps your profit. You're not going to earn anything additional, even if the underlying price moves higher. And the reason is that any gains on buying this call are offset at that point by the losses on that call that you sold. So the two net out, and effectively your profit doesn't change when you consider these two options traded together. So this is called a bull spread. And it's positioned to profit whenever the underlying rises. up to a point. Another strategy is called the bear spread. And the bear spread is when you're expecting the price of the stock to fall. The bear spread works in an opposite manner to a bull spread. Here we buy a put instead of a call, but we buy the put at a higher strike price. But to offset the cost of doing that, we also sell a put at a lower strike price. So what that means is that we're going to receive a premium from selling this put, and then we're going to use that to offset some of the cost. That is the cost of buying this higher strike put. And what's going to happen is that at the higher values of this underlying stock price, our put is not going to make any money. Buying the put won't kick in until the stock price drops below that strike. And then it's going to kick in, and then we'll start producing profit on that put option that we bought. But only up to a certain point, because as the stock price falls from this strike price here to the strike price that we sold our lower strike put at, then our position is kind of flattened out. That is, the gains from buying the higher strike put are offset by the losses on selling the lower strike. And so what we do with a bear spread is we profit from a fall in the value of the stock, and we do so cheaply because it's sort of like we financed the purchase of that put by selling one at a lower strike. But as a consequence, we've kind of narrowed our range of potential profitable outcomes to this region here, the region in between the two strike prices. Now there's one caveat to that, and that's that we have to consider the cost of buying the option and the benefit of offsetting that cost by selling the other option. So if we're going to calculate the break-even point, the point at which the stock needs to fall for us to make a profit, we need to take a look at that. So the break-even point in general is the amount that the stock or the underlying needs to move in order for this option strategy that we're looking at to be making money for us. And for a break-even point on a bear spread, since we're betting on a fall in the stock, this is the amount that the stock needs to fall by in order for us to start making money. If we were buying a put and just looking at that, that is, if we were just looking at this part, buying a put at this higher strike price, then let's call that strike price X, and then let's just denote it, that's the higher strike price one, by doing this sub H here. Then this put itself would be in the money. It would be at its break even when the stock price goes below the strike, but after accounting for the premium P here of that higher priced option that we bought. So if, for example, you bought a strike price of $20 and the underlying is at 25, then if it drops below $20, then this option's in the money, but you didn't actually turn a profit. You didn't actually even get to the point of break even until it drops by enough to cover the cost of your premium. And so if your premium is $19, then actually the stock itself needs to drop not to 20, but below 19 in order for you to make a profit. The premium is $1, and so you've got to account for that here. The stock has to go below 19 in order for you to be at break even. But that's just this part of the option strategy for a bear spread. So we also have to consider that we sold a put at a lower strike and earned some money from selling that premium. And so the way that we account for that is to just net out that premium that we earned selling at the lower strike price. So the net break even here, let's again attach some numbers to it. The strike saying it's a $20 put. So notice that the strike, this is the strike for the option that we're buying at the higher strike. And our premium for that was $1. And let's say that the premium that we received from selling the lower strike put is 50 cents. Then it's no longer going to be a break-even point where it's going to be $19. It's instead going to be that $1 that we paid minus the 50 cents that we received from selling the lower strike option. So it's now at $19.50, our break-even point. We went from $19 to $19.50 because of this bear spread. And so that's the benefit of a bear spread. You can lower the effective cost of financing this option, and as a result, the stock price doesn't need to drop as far before you start making money on this strategy. And if we look at how that plays out on a profit and loss diagram, then we can plot our break-even price here, the price at which the underlying needs to fall to before this strategy is going to be making money. And then the one other thing that we'll need to know is the strike price for this put option that we sold. It was a lower strike price, and let's say it's $17. Then we can also plot the strike price of the option that we bought. That's that $20. And the strike price of the put option that we sold, the $17. And those two dotted lines, these vertical lines here, the strike price of the put we sold and the strike price of the put we bought, these will cap the range of outcomes that we can experience for this option strategy. So what's being plotted here is our profit. And so let's say for the strategy, this point on the y-axis is a profit of $0. We didn't make any money, and anything above, anything below. Then for anything in this range of outcomes, for the range of what the stock price, the underlying does, whether it goes low all the way to high, well, we know that with this put option that we bought, it's not going to be making us any money until that stock price falls below the strike, this point here. But that it's not really going to make us money until we cover the cost of the premium, the net premium from paying the higher priced strike and receiving or selling the lower priced put. And so we're not going to make money until it reaches, the stock price falls below the break-even point, that $19.50 we looked at. That's plotted right here. At that point is where this option strategy will start to produce real profit for us. And if we were just done there, that we didn't sell a put, then the option profit would just look continually like this. The more the underlying fell, the more that we would make. But since we did sell at that lower strike of $17, then once the underlying falls below 17, then that put option that we sold kicks in. That put option will start delivering losses to us. But, and this is the critical point of this bear spread strategy, those losses are exactly offset by additional gains in the put option that we bought, that higher striked put option. And so our payoff profile, really the region where we make money, is this point here, this triangular region. And here we, if it still falls, we still make money. It's just we don't make anything more than this point right here. And, you might ask yourself, why would I do this? Why wouldn't I just buy, if I thought the stock price was going to fall, why wouldn't I just buy a put and be done with it? I'd get, the chance to go all the way up here. And the answer to that is that you do this because you think that the stock price will fall, sure, maybe down to here, but you don't think that it'll fall below 17. If that's what you think, then you can actually produce more profit for yourself by sort of selling. You're effectively selling this end of the distribution. By lowering your break even, well, I guess technically it's increasing your break even from $19 to 19.50 cents. But by making it easier, that is allowing the stock price to fall less before this strategy starts kicking in and making money, $19.50 versus falling to $19, you're giving yourself a greater chance of profit because the stock price itself doesn't have to fall by as much before your option strategy starts producing money. So as long as you don't think it'll fall to this region within here, then this bear spread here is a more optimal trading strategy. It's a more profitable strategy for you. So with the bear spread and with the bull spread, you can note that you're trading either puts or either calls. Like the bear spread here, you're buying two puts, one at a higher strike and one at a lower strike. You're buying one put and you're selling the other, but they're both puts. That's different than something called an options combination, which oftentimes involves both buying and selling puts and calls on the same strategy. And so one combination strategy that's important to illustrate is something called a straddle. And this is one that I find fascinating because it's a way to trade or profit not on the direction that the stock price goes up or down. You're not betting on whether the stock price goes up or down, in other words. What you're betting on is that the volatility of the stock price goes up or the volatility goes down. And trading volatility in this way is a very unique thing, unique in the options market. Something that's there for trading options that you can't normally do in other types of assets. Here you can be wrong about the direction of where the stock price went, and it doesn't matter. All that matters for this is by how much it went up or by how much it went down. So specifically, a straddle is when you buy a put, but at the same time you also buy a call on the same underlying stock. And for both of these, they should have the same strike and the same expiration date. And you might wonder why this would make sense. Like, it's almost like you're betting on the price falling and then you're also betting on the price rising. But let's take a look at the payoff. And if we do, I think it'll make more sense. So the strike price for both of these puts and calls, the put and the call that we're going to buy is the same. Let's say they're both $20 strikes. Now, they may not cost the same, and just so that we can kind of keep track of which is which, let's actually make sure that they don't cost the same. Let's say the premium is $3 for the put, but it's $2 for the call, and then their expiration date will also be the same. This actually doesn't matter that much. I mean, it will affect the cost of the premium, but the point is that they're the same. And let's just say it expires. These are 1-year options. They both expire 1 year from now. And let's say that these are at the money options. That means right now, for the underlying stock that these options are both written on, the stock price is $20. You actually have to have, when you're doing this strategy, if you're not making a true directional bet on whether you think the price is going to go up or down, you actually have to be trading at the money options. Otherwise, there's going to be an implicit bet about the direction of the stock price. So these options have to be at the money if you want to really just trade volatility and not make a directional bet. So this straddle, let's see how we would make profit. To make a profit on this strategy, we first should calculate the break-even point. And it's almost like we have 2 break-even points now, because either the stock can go up or it can go down. We're going to make money either way, but the thing is we have to look at the total cost, the cost of buying the put, the premium of the put, plus the premium of the call. And so the cost of this strategy together, since we didn't sell any options here, we just bought them, is the $3 that you see plus the $2. So it cost us $5 to buy this thing with a strike price of 20. And those 2 things are actually all we really need to know to calculate the break-even. Because if it costs us $5 to enter into this strategy and the strike is 20, then as long as the underlying moves by more than $5 in either direction, if it falls by 5 or if it rises by 5, then anything beyond that, any further fall or any further gain, is pure profit. At that point, we've more than covered the cost of buying this option, the $5, and the rest is profit. The reason why this works is that one of these options will be very profitable. Let's say that the stock price goes to $27, then this call that we bought is in the money. It will have produced plenty of profit. In fact, here it's just $7, and we can see it's a $2 profit because we subtract out the $5 cost of both of these options. And meanwhile, while this is the profit for the call, the put that we bought is basically worthless. If the stock price is at $27 and the strike is at 20, the put's not making any money for us. And so we can effectively consider the premium there as 0. And so that's if the underlying increased in value, and just for illustration, let's suppose that it went the other way. Let's say the stock price falls instead to $12. So with a strike of 20 for both of these options, if the stock price fell, then we know our call option is basically written off. Our call option is worth 0. But we know that the put that we bought is now worth something because the stock price has fallen, and the put formula is the maximum of x minus s, or 0. So in this case, the 20 minus 12 is $8. So the put is now profiting by $8. And if we subtract out the cost of the net cost of this entire strategy, the two premiums that we paid together, or the $5, then the total profit for this strategy, if the stock price falls to a sufficient level, is the $8 minus the cost, the 5, or $3 profit. And so with a straddle, you really don't care about whether the stock rises or falls. What you care about is that it rises or falls enough to offset the net cost of both of these premiums. And as long as it falls by or rises by that amount, then your net strategy, your net profit for this strategy, these two options combined, will be profitable. And so the payoff diagram for something like that is actually a little unusual relative to the payoff diagrams that we've seen. The option strategy profit shown here on the y-axis, as the underlying goes from 0 to increasing in value, what happens is that your strike price is still, we can plot that here, strike price of $20, but your break even is, well, if it moves beyond $5, as we calculated above, or if it falls by at least $5, as we calculated above, then we're golden. We'll be, as long as it moves outside of that range, then we'll make money. Otherwise, we're out the cost of the premium. So we start out here at the strike. But when the spot moves away from the strike, if it moves above $25, then anything beyond that is going to be profitable for this strategy. And if the underlying falls by more than $5, that too is profitable. So we basically make this amount of money. This is sort of our region of profit. As long as it goes outside of this range right here, then this straddle is profitable. By the way, what we just looked at for straddles, that's something called a long straddle. And what we're long is not the underlying price itself. We're long on volatility. With a long strategy, we're betting on a higher volatility. If the stock price, ranges above or below a certain range, then there's profit. But it's also worth pointing out that there is something called a short straddle. There is a way to bet on decreasing volatility. That is, you can put yourself into a position where you profit if the stock price doesn't move by too much over the life of the options. So we've seen how a long straddle works. That's where you buy a put and you buy a call, and they have the same strike, expiration date, and they're both at the money. A short straddle is just the opposite. So rather than buying a put and buying a call, the only difference is that you sell both. Sell a put, sell a call. Still have the same strike, expiration date, and moneyness. But a short straddle is a bit more of a, well, not a bit, it's quite a bit more risky of a position, unless you combine with other option strategies that are beyond scope at the moment. Because a short straddle payoff looks like this. If you're selling calls and puts on an at the money option, then you're starting off with a profit because you're collecting premiums on both sides. So if the underlying stays at the strike, let's say it's $20 still, and let's say that when you sold, you collected a $3 premium for each of the put and the call that you sold, so a net premium of $6. Then as long as the stock doesn't move by more than $6 either way, then you're fine. You won't incur a loss. You'll reduce the premiums will be reduced. But as long as the stock price stays within this range here, this $26 through $14, as long as by the time expiration happens it's within this range, then both options will, well, the net effect is that the premium that you collect, the $6, will be more than enough to cover the cost of those two options together. But if the stock price moves outside of this range, if it falls by more than $14, or if it rises by more than $26, you'll lose money. So with a short strategy, you're short volatility, because if volatility rises, then this is where you're going to lose money. And in fact, if the stock price rises by a crazy amount, then you can lose crazy amounts of money too. So that's why I say the short straddle is more risky than the long straddle, because the long straddle, the most you can just lose is the premiums. But with a short straddle, the most you can lose is unlimited. It's unlimited because the price itself can go as high as it ever will. There's no limit on how high the price can go. Okay, one other option strategy to talk about, and this is the spread strategy. It's called a calendar spread. And the way it works is that with a long calendar spread, you sell a nearer to expiry call, a short dated call, but at the same time, you buy a long dated call. It's the same underlying and the same strike for both of these options. One reason why you might do this long calendar spread is that you expect the stock price to rise far out into the future, but not in the near term. Maybe you think it'll rise over the next year, and so you buy a 1-year option, but you don't think it'll rise over the next 2 months, and so you sell a 2-month option. And by doing it this way, rather than just buying the long dated call, just like with a bull and bear spread, the benefit is that by selling the short dated call for a premium, receiving the premium, you lower your cost outlay. So it's potentially a more profitable approach. But another benefit to the long calendar spread is that you're short time decay. And what that means is that the value of a call option or a put option, the value as a function of time to maturity, if it's a really long dated option, there's a lot of value. The option is more expensive the farther it is out into maturity, because a lot can happen between now and then. And if this is the range of outcomes that might happen for this stock, and you're buying an option on it, the option means that you can walk away from all that downside, but keep all that upside. And so having a longer dated option means there's just that many more opportunities for upside, and yet still the same ability to walk away from all the downside risk. So longer dated options are more valuable. And as there's this thing that happens called time decay, as you get closer to maturity, there's less of a chance that something big will happen. And the closer you get to expiration, the greater that time decay occurs, that the greater the drop, the relative drop in the value of the option as you get closer to maturity. And so what's happening is that you're selling an option that is falling in value at a faster rate than the longer dated call option that you bought. And so it's kind of like a tailwind to this long calendar spread strategy. So there are two benefits to a long calendar spread, reasons why you might want to do that. But it's also worth noting that you can also do something called a short calendar spread, and that's just the opposite. You're buying a near to expiration date call, and then you're selling a longer dated call. And the expectation is that you think that the stock will rise in the short term but fall in the long run. And so by selling a longer dated call, you're receiving a premium, and some of that premium is going to offset the cost of buying this shorter dated call. And so you lower your cost outlay, and if you're right, can have more profit as a result. But the side effect is that you're short this time decay. You're like on the reverse side of this concept that we talked about with the long calendar spread. So with a short calendar spread, one thing you have to be aware of is that you're fighting this time decay. Still, it can be a viable strategy to lower your cost outlay if you think that the asset will rise in the short term but fall back down over